All right, time for the next session. Just for everybody's information, there's tea, coffee, etc. outside, but I would rather have you guys here. The next session is, I think, to my mind, one of the most interesting ones, especially because we have a lot of family offices and investors or to-be investors in the crowd here. The title of this section is Perspectives from the Money Managers. So now we are here to listen directly from money managers who've actually been there, done that a lot. One of the agendas of this platform, like I shared in the beginning itself, is to bring money managers together and so that they can shed light on what is happening across the ecosystem and not just at the angel level, but the broader investment landscape. When we think of investing in early stage companies, when we think of backing startups, we have to have an understanding of the macro environment. And I think this panel here by money managers is going to help us do that. Let me invite the host, the moderator here, Mr. KRS Jamwal, one and only. He's the executive director at Tata Industries. And there are two things I would like to highlight about his background, which are not very well known. The first is that he's navigated exhilarating highs and challenging lows of launching new technologies and consumer businesses. So I think he's seen it all, the highs and the lows, etc. That's one. And the second is that he's also been involved very closely in turning around difficult situations and unprofitable businesses, etc. So I think we have a lot of experiences to be shared here. Mr. Jamwal, I invite you to call on the panel and then let's get it started.
Thank you. I have a fascinating panel here. So, Munish, Madhu, Rahul, would you join me on the stage, please? Okay, let me, good evening everyone. Good to be here. Let me introduce my three panelists. Next to me is Madhu Lunawat. She is the managing director of the Wealth Company and co-founder of Pantomath Group. They currently manage over $1 billion in assets, and she has recently raised 3,500 crores in just 6 months through Bharat Value Funds. She brings unique perspectives from a background in asset reconstruction and investment from an early part of her career in Edelweiss ARC. On the other end is Munish Randev, founder and CEO of Cervin Family Offices and Advisors. He has over 30 years of investing experience, and with his co-founders, they come to over 100 years of collective experience. They currently manage over 3 billion in funds for family offices, and they are recognized in a structured approach to establishing and managing family offices. Earlier lives with ABN AMRO, Fidelity, and Avendus. Then we have Rahul. Rahul is with Games 24/7. Just turn this if you don't mind. Thank you. They have long and talented bios, so I don't want to make sure I don't miss anything out. He brings a unique dual perspective from both investment banking and corporate finance with over 2 decades of leadership experience. Rahul Tewari is Chief Financial Officer at Games 24/7, and we are going to look for him for a combination of technology and finance, the intersection, and he's been on both sides. He's been a banker in a past life with ISEC, Bank of America, and Deutsche. Let's begin this session And as it was introduced, we're looking to get perspectives on what money managers look for in terms of businesses, investment. And the first part of the session is how does the capital journey for entrepreneurs look at from their point of view. So let me talk to Madhu first. You have a reputation, Madhu, of finding high growth businesses from tier 2 and tier 3 cities. What do you look for in these entrepreneurs, and how do you identify what are the high potential entrepreneurs from these? And our audience has a lot of entrepreneurs and charter members. So I think your perspective will be very useful.
Sure. Thank you, sir. Tier 2, the word may sound very, not very classy for our Mumbai fund managers. But let me tell you, if you want to make money, that's the place we all have to be there. Because by the time a promoter migrates to Mumbai, lot of your value, has already been capitalized. So we expertise in going to these clusters, industrial clusters, which are located in tier 2, tier 3 cities in India. And the beautiful part in these entrepreneurs is, आपको उनको धंधा सिखाने की जरूरत नहीं है. They come with a vintage of 20, 30 years. So like we have portfolio companies which are 50 years into the business. We have portfolio companies which are into 30 years into the business. So the average vintage of portfolio companies is 15, 20 years, which means they would have seen a lot of business cycles. So the 80% weightage, what we give into sustainability, what we give into growth-oriented businesses, is taken care when you go to tier 2, identify good growth-oriented family-run businesses. Now, second important point we also see there is they are not diluted too much. So in fact, in the last 2 years, we have invested in 25 plus companies from these industrial clusters. And let me tell you, we are the first institution check to them. They have never diluted. 100% promoter holding is within the family. So that makes lives very easier, because if there's a downturn, we want to raise more capital, there's a lot of room available for it. And third and most important is the growth which they bring, because all these businesses are north of 500 crores of top line. So your risk as a fund manager, we are here to minimize risk and maximize returns. So these tier 2 offers us potential alpha, which we can create as fund managers, while you minimize your risk to a great extent.
Thank you, Madhu. I'm going to tap into Madhu for a couple of seconds more by mentioning that she is one of the key people as pre-IPO investors. And I'm going to break down my questions to her in 2 parts. Later on will come the interesting part of what's happening to pre-IPO in future. But from your experience in helping these tier 2, and your insight is fascinating that they are diluted less and they usually have the dhanda pretty strong. What advice would you give to anybody here who's looking at pre-IPO, whether on small board or big board?
So ideally, I would say you be in your factory, be in your place of, wherever you are manufacturing or industrial, whatever you do. We as fund managers, we go and, we will hunt you, if for the lack of better word. But yes, definitely, focus on corporate governance, cleaning up balance sheets helps a lot. If you have done that process, gone through that process, it makes lives easier for us. And it also helps in, minimizing the transaction time. So for example, and it's a surprise to most of the industry players here, the average time taken by us, and let me tell you, we have one of the very strict processes. The average time taken by us to complete deals is 2 months. So, we can prepone your growth cycle because for that timelines.
So, good advice. Find the right partner and have the right governance. It's a good segue to what I wanted to ask Munish about. And, Munish advises a lot of family offices. I can see all the entrepreneurs who are listening to this perking up their ears, both on Madhu's advice and on Munish introduction. So Munish, in terms of advising family offices, give us a sense of what do family offices look for when they're investing, either based on your advice and directly into startups, companies, businesses. And let me ask the follow-on itself, that what advice would you give to entrepreneurs who want to position themselves to attract these family offices?
Thank you, Mr. Jamwal, and thank you, TiE Mumbai, for inviting me here. Very importantly, I think a good news to many of the startup entrepreneurs, if they are in this room or outside this room, I think I can tell you this, that you've not even seen the tip of the iceberg as far as family office investments into startups is concerned. We are just starting off. And what you see, the kind of money which funds are raising and investing into startups, actually it will look very, very small when you look at the size of family wealth which is getting created over the next few years. I don't know if some of you know it, but there are almost like 1 lakh crore worth of assets being shifted from one generation to the other. And the next generation which is coming in is already allocating to a lot of the early stage ventures. So one is, Mr. Jamwal, a good sense that there is a lot of money. I think what your question about what people look for when you are investing, I think 10 years back or 15 years back, when this whole VC thing was hot, heating up, a lot of people thought, if you had a good presentation and you could really emote and give a good presentation to the investors, there's a lot of money which was lying there to be taken. Things have now changed quite drastically. I think now families themselves have also come up the curve over the last 10, 15 years. I can tell you this, every family office that you hear about, $1 billion, $2 billion, $3 billion family offices, they have a history of errors they have made in the last 15 years. I think now they're getting a semblance of what they are looking for. They are not looking for the best model. They are not looking for the best EBITDA numbers from the projected models. They're actually looking for the right set of people. The person behind that startup, that's the most crucial thing these family offices look for. Beyond funds which are there in India, I think one very important part is family business owners who set up family offices, they have a huge business ecosystem. They can actually find out about that founder within 3 phone calls. So I think what people are now looking for are people either who have huge domain experience and can execute that idea, or they already have experience in executing that idea somewhere earlier in their lifetimes. So family offices are, in a nutshell, looking for people, and then the processes, and then maybe something about what your business model is, what kind of EBITDA numbers, because these are all Excel exercises which you can do. So I think people, number one. Very importantly, I think you added on the question then what should entrepreneurs do to reach out to these families? And I think that's the biggest challenge entrepreneurs have today. First of all, let's be honest, entrepreneurs' first port of call is always a good fund, because they believe the fund can really add value, and they do add value in various shapes and sizes. What family offices add is a bit more than just the money and the wealth. I mean, they have a relationship capital which they bring domain expertise. Mr. Jamwal and we were chatting about the consumer space, where a few of the family offices from consumer domains have literally helped their startups in inventory management, logistics and all this kind of stuff. So families can give you a lot more. So when you actually reach out to them, just don't look at the purse that you're trying to get into. See what else can you have from that family office. And if you do a bit of a homework before you pitch to a family office, you can realize you're pitching to an FMCG family office and your pitch deck is already prepared for a fund, which is a deep tech fund. Now, you can't use the same pitch deck to compose. So I think they have to mold their approach a bit, but there is enough money on the table from family offices in the next 10, 15 years. I'll not be surprised 10 years later when we sit here, family offices may be the largest investors in this ecosystem as compared to even funds.
Well said, Munish. By the way, I think at least all the entrepreneurs and the angel investors and VCs should keep an eye on the whole family office space. Some of you may have seen a recent Financial Times article which said that the total money under family offices is now 4.5 trillion. And it is more than the money which is in VC. And of course, the Financial Times, being slightly liberal, was actually raising the alarm that this is too much money and too much power in family offices. But that also means that people like Madhu and Munish are a little ahead of the curve. In the next 10 years, they are going to be the gatekeepers for potentially the largest pool of money. I know I'm going to keep in touch with them because in my private capacity as an angel investor, I'm going to start asking them, which is the family office that you think is right for this startup? In fact, my next step is going to ask them to create a guide, which family office is interested in what startups. I think that will be a value addition to the ecosystem. Coming to Rahul. Rahul, you can give us a sort of two-sided view that now that you've heard some aspects of the family office perspective. People, insight, domain knowledge. What do you feel is probably the largest misconception that entrepreneurs have in terms of money and capital? And both, we all know that entrepreneurs think money is the most important thing for them and everything else follows as success. But give us some of the misconceptions around both raising money and what money does for them.
I think that's an important aspect. And I think we were talking about that sometimes entrepreneurs think it's the lack of capital that's stopping them from growth. We come from a very different perspective in terms of the pool of capital. At Games 24/7, we have a corporate venture capital arm. And that kind of capital kind of relates to the family offices in the sense that there's a lot of operational perspective when we look at investment ideas and entrepreneurs. But I think a lot of that philosophy is also guided by how we evolved and how we grew as a platform. Games 24/7 is an 18-year-old company. So when we started, there wasn't any capital available, the kind of startup capital which is available from family offices, venture capital funds. So we were forced to evolve in an era of frugality. And I think that kind of proves the thesis that capital is really not that important. And I remember when I joined the company, and we raised capital after a very long period of time. That's when we became a unicorn. Until that time, the company had raised very little primary capital. So I think the intense focus on the product, on unit economics, and kind of just sweating the capital more is, I think, more important. So I think sometimes, yes, capital is a force multiplier, but it is also not always a boon. It could be a bane in the sense that we've seen where plenty of capital was available, and then there were platforms that were given a lot of capital, and they moved in directions at a speed which actually destroyed a lot of value. Set of valuation benchmarks which were very, very unreasonable, and it created kind of barriers for entrepreneurs to raise capital later on. So I think capital is important, but not the only factor for value creation.
Can I just add one point? A very important point he pinged upon is sometimes excess capital is the biggest destroyer of entrepreneurs as well. We are now seeing some of these examples coming out, but sometimes the capital is thrown at them so easily, and with kind of volumes that they have, they naturally feel pressurized to do esoteric kind of valuation and esoteric kind of raise. I think we are going through that first phase of 10, 15 years when you're trying to now understand, okay, this will not work in the future. And especially if you're looking for IPOs, that will surely not work. So, capital also has a duality of effect.
Thank you, Munish. I wonder if people are picking up on how different the perspectives are from this panel from what you would get on a VC panel. At least I'm getting those things, and it's a very interesting thing. And I've not even touched about the fact that perhaps at one level, family office capital is also a little more longer term and doesn't have a defined endpoint. But coming to some of the aspects that were touched upon in the previous session, and moving to the next stage, which is how really do family offices and the people who manage the money of family offices, how are they different from VCs? So, Madhu, operationally and in terms of engaging with them, you touched upon how the entrepreneurs were different from tier 2. But from the point of view of how different is the approach of these family offices to those entrepreneurs, operational perspective, sustainability with rapid growth perspective, I'm going to ask you that question, then I'm going to also ask Munish to also touch on certain aspects, but you go first.
Yeah, so sustainability, it's not a mere word. While we as a fund are signatories to PRI, laid out down by United Nations. But let me tell you, and it's the fault of investors like us, we force the founder to such extent that we get into predatory pricing. And we have seen how businesses have failed. Without taking some names, as we speak also, there's a new antitrust which is going on currently, the case is going on. So it is very important for founders like us not only to scale businesses at the cost of everything else, because we are responsible to what we are creating and what we are giving back to the society. Having said that, in operational aspect, we focus a lot on sales first, and we do that because, see, in the tier 2 segment, you will find typically it's a one-man show. The promoter would be doing, sales, he'll be doing purchases, he'll be also doing company secretary, governance, everything. So what we do is, once we get into those businesses, once we have identified the entrepreneur, we help them release the bandwidth, so he can focus on strategy and sales, and rest other we bring operations in line, which can take care of those things, and that helps the entrepreneur focus more on sustainability, focus more on growth, and not growth at any cost. So which is very, very important for us.
Thank you, Madhu. And Munish, your take on, I think earlier when we were talking, I sensed that some of the founders, some of the family offices that you deal with are fairly hands-on when they want to get a message across to a founder. So give us the pluses and minuses of it, because it probably takes a certain DNA of a founder to work well with a family office.
True, and again, it's a boon and a bane. So one thing which we see is, if you look at LinkedIn profiles of very, the third generation, fourth generation family office owners or family business owners, they love to use that word angel investor. Even if you put 5 lakh rupees or 2 lakh rupees, you can become an angel investor. But the thing is that the challenges of having a family office on your cap table, it can be again a boon and a bane. Boon, as Mr. Jamwal was saying, that they can add a lot of value. Besides the money, they can come with domain experience, they can come with relationship value, they can open far more doors. Because do remember, a family business owner who's setting up a family office has been there and done that in an industry which was not so easy to give. Not all of them are tech promoters by background. They're literally running hardcore businesses. So I think they can add that domain. We have seen families who actually help these founders out in areas which the founders are literally blindsided upon. I have yet to meet a founder of an early stage company which has the HR part clearly taken care of, the financial governance taken care of, their half-yearly or reporting processes taken care of. Families can affect those. And in domains, as I said, they can help you in much more areas which they themselves are working on in their own businesses. So that's a boon. The bane comes in when family offices ask for your time from the founder. Now, the most precious commodity of a founder is his time, because he's utilizing time to multiply the money that has been investing in him. Now, they can't be reporting to these family offices every month and share the report, get a 2-hour meeting. I think that's something which family offices are now understanding is not something they will get. Because the expectation was, if I've invested money somewhere, the fund manager / the founder should be at my beck and call. So I think family offices can add value. I think it's for the founder to put the expectations right at the beginning itself. And that's the work as advisors to large family offices. We make sure that happens, because we want that relationship to grow, or not just for one raise, but for multiple raises.
Interesting. That means your value add, Munish, is not just advising on money, but probably also for the younger family offices placing boundary conditions and setting expectations on both sides.
Absolutely. And for example, it's less of a financial investment business. It's more of a psychiatrist and a psychoanalyst, just to make sure you can mentor the family offices. They don't make the same mistakes what others have made, maybe.
Very interesting. Rahul, I'm going to take a segue from what Munish was saying about financial sort of fitness that the family office can help. And in your case, what advice for founders and entrepreneurs in terms of the financial relationships and the financial infrastructure that they should be looking at fairly early in the journey? Plus, how do they sort of, perhaps because you've done both the corporate finance and the fund job, how do they best position themselves to M&A opportunities that are favorable to them? Complex question, but I'm sure you can tackle it.
So I think when we look at the playbook for investing, I think it pretty much remains the same. Be it family office or corporate venture capital fund, is the size of the prize, what's the TAM. It's basically what is your right to win or right to play. It could be product differentiation, it could be business model innovation. So I think those fundamentals remain the same. I think what I've seen in some of the portfolio companies is that sometimes the founders are too kind of keep a head down and keep on executing, and they lose the context around them, which is what it means is the founders or the entrepreneurs are not externalizing their thinking, and they don't kind of relate to the entire industry ecosystem. So they don't kind of think about very deeply about what is a long-term differentiation that they're creating. And I think early on, that's where the VCs and the investors can play a role in actually helping these entrepreneurs to actually think about, okay, is there a potential for a partnership, let's say, that can really hyperscale your journey? Is there a product innovation which is possible by bringing in a small team of entrepreneurs and do a acqui-hire kind of a transaction? Is there a competitor or a potential acquirer that you should start building some network or relationship with? And I think that's where, it's I think one of the big value addition that investors should bring onto the table. And that's where I think sometimes entrepreneurs are looking for that value addition, frankly speaking.
Thank you, Rahul. And I will add one more thing. All the panelists have touched upon whether it's pre-IPO or even when you have investors on your cap table, your capability in making sure your financial numbers are both clean and well recorded. It also becomes very important, not just in pre-IPO, but even in M&A. Most M&A deals at a small scale fail because when people go in, either the numbers are completely off or they're just not kept well, and therefore what's seen from outside and when a person goes in and looks at the numbers after a diligence is so far apart that the deal falls through. I want to touch on technology because, family offices, one automatically assumes that VCs are more tech savvy than family offices and people managing family wealth. My pre-panel conversation disabused me of that notion. So I'm going to first ask, actually Rahul first, that, how is technology changing the relationship between businesses and financial partners? How are you, because you're a tech company, so, I presume you're leveraging technology as much as you can.
And I think in terms of evaluation, also validation, I think more than just technology is the data. And I think, a lot of data is being generated. And I think investors who are not kind of leveraging data are kind of losing out on the perspective of, what is the worth of that particular company. And we, I think, as a gaming company, do that pretty well. And I'm kind of saying this very humbly because by studying the behavior of the customers on the platform, we are able to develop insights and then hyper-personalize the product or the journey of the players. And this is something where I think as investors, you have to be in a position to develop pipes, for that information to flow in as you're making your investment decisions. Also, early warning system when things are going wrong. And sometimes what the entrepreneur is telling you and what is there actually inside the hood are two very different things. So if you're not kind of leveraging technology to collect like basic operating or financial data, then you're not prepared, for the long journey.
So are you saying that your data capabilities allow you to be more predictable, to better predict revenues and the entire financial numbers? That's how you leverage it?
Yeah, because I think when our product teams or marketing teams actually make decisions, we have put guardrails which are solely based on data. So I think we are able to predict the customer behavior. Ours is a very high retention product. So we are able to make decisions around, how much to spend, when to spend, and then kind of, focus on the ROI of those spends.
So Madhu, please disabuse the audience on the fact that family offices don't use AI and data. I think she should talk to all of you how much they leverage AI and data, both from her fund perspective and the advice she gives the family offices.
So contrary to our traditional approach, we use a lot of AI, we use a lot of data. We manage this corpus with only 6-member team. And we use technology in twofold. First is, India has more than 7 crore entities, which you have to go through and select. There's a complete process. So we have our proprietary tool where we analyze more than 600 data points, publicly available sources. And let me tell you, I'm talking of unlisted companies where structured data availability is very, very low. So this proprietary tool, which is built over, last 10 years of learnings, our own failures, our own successes, takes care of all the 600 data points and throws a 100+ page report. So if you are an entrepreneur in Morbi and I want to meet you tomorrow, so I will just put the name, and within 30 seconds, the tool will give me that 100-page report about the key things which we cover is who are the auditors, last 5 years is then change in auditor, if there's an adverse remark in audit report, all your legal cases, GST filing pattern, TDS, so on and so forth. Even who are your ex-employees, so that I can talk to them whether आप salary time पे दे रहे हो कि नहीं, आप कितने घंटे office में बिताते हो, which is very important for us. Secondly, we also have invested in a data platform which helps us help our portfolio company in sales, in distribution tie-ups, in hiring, and third, most importantly, in inorganic acquisitions.
Very good. So let's take Munish to take us into the final section. While you can talk about anything you do on AI and data, but I think given the time constraint, just go also into what are you looking at for future trends? What are the family offices you advise, guide, manage their wealth? What are they? How are their priorities shifting? And what advice would you have to people in this room who are businessmen or entrepreneurs that would be useful as areas of interest for the family office money that you manage?
Sure. So very briefly, I think in the Indian venture capital fund ecosystem, we've got very established players now. There are people with Vintage Fund 3, Vintage Fund 4, Vintage Fund 5. So I think that's becoming a very matured ecosystem. Family offices, because they are very scattered and very non-connected in nature, I think many of them do the same mistakes, make the same mistakes, and then they learn on their own. So there's a learning curve with most family offices. I think now I can tell you, I think with our ecosystem of almost 150, 175 family offices that we exchange information and data, especially regarding the venture capital investments, what we are seeing right now is I think the family offices have also come a bit matured. I think they've gone through that learning curve, understood what the mistakes were. Had they come earlier to us, we would have made sure they didn't do the mistakes, but they have learned that, and sometimes you end up making them, allow them to make mistakes, because that's the only thing most of them will remember. But I think now we are at a stage where they've understood what they are supposed to do and they are not supposed to do. Imagine an FMCG-led family office trying to do a diligence on a deep tech opportunity. Let's take electric motor for movements of satellites in various orbits. Now you can't do that, right? Because you have no capability. Yes, you can be excited about it, but I think they have now realized which are the areas which you want to invest directly, which are the areas you don't want to do directly. There will still be some areas they want to do piggy banking on their friends and their ecosystem, but leave the rest to the funds, because there are good fund managers in the country, they know their jobs. So you should know, jiska kaam usi ko saje wala. Sometimes spaces which you know where you can add value, invest directly. There are some spaces where somebody else can add value which you know of, invest there. If you don't understand anything, no connects, please goes to a fund and invest in that fund. So I think that's the sort.
Do you see FOMO with family offices also? So if space tech is hot, do you start getting queries from family offices कि हम space tech में क्यों नहीं है?
So अभी भी आ सकते हैं. So the opportunities are still there. I think Indian space sector is big, but I think FOMO के बाद अब JOMO भी आ गया, joys of missing out. So I think the way last 2 years have panned out, 3 years have panned out, so people are also witnessing that. So it works both ways, I guess.
Good segue for me to ask Madhu, because Madhu's and her team does a lot of pre-IPO stuff, and now with the markets, I don't know what happened today, but with the markets being a little red. Okay. I'm very curious that what is Madhu's take on what's happening in the whole pre-IPO space. First of all, what happened in the last 1 year for all the people who did pre-IPO, and what do you see going forward in pre-IPO?
So Pre-IPO, that way is a very great tool for Indian entrepreneurs because we still are a capital deficient, country. We are capitalizing a lot. Let me accept the fact we are a developing nation, so a lot of capital is required. So, and for funds and even family offices, we are that way patient in our approach. So we have a horizon of 5 years for our portfolio companies. And these black swan events or, the kind of FI is going away and we are seeing in the market will come and go. But what is most important, sir, here is the value at which you have entered. What has happened in the past, if I can say so, if this bottle is valued at 10, we would have all entered because of FOMO. We have entered at 50. And after 3 years, when I want to sell it, I am surprised because the markets are down. How do I sell? No, there are no takers at 50. So we, being a value investors, we take care at what price. For us, most important is आप किस price पे entry कर रहे हो. So that even in down markets, being a value investor, आपका पैसा बनना चाहिए. And ultimately, we all are responsible for our, to our investors.
Thank you, Madhu. Rahul, you get the last word of the official section unless there's some urgent questions. So what do you see as the trends going forward in terms of how money contributes to creating the most value for technology companies? Let's bring it back into technology companies. And what strategies and insights have you found that are used by technology companies? You already touched on data, so that was a good takeaway, and I hope people got that while tech companies can leverage data to give a lot of predictability and assurance to investors, is there any other final word you have that people can learn from you guys?
So I think when I think about technology companies, revenue comes in all different shades. And then there are quality of revenue which is higher. So kind of think about a technology platform that has created some differentiation. But I think much of the success lies in terms of what do they do with, let's say, the initial user base which they've created based on that first, let's say, product innovation. And I think we've seen that cross-monetization actually to different related product areas, white spaces around the core product, actually has unleashed a lot of value, for these platforms. Also, we've seen that technology platforms might start with data first or tech first approach, but eventually India is a country where you have to go offline a little bit. So kind of, finding value in terms of transactionalizing the experience for the users will force you to go outside of just the digital, the mobile world into actually offline delivery. So I think that kind of innovation is also important to unlock value.
Very useful. I've had a lot of fun and I've learned a lot. I think Time's Up was here right from the time we came up on this stage, so that's fine. 30 seconds for any question that people are desperate to ask. Otherwise, the panelists are here. You can catch hold of them over a cup of coffee. I think they bring a wealth of experience. I've had a lot of fun. Thank you, everyone.
Thank you, sir. Thank you so much. Yes, photo time. All right. Thank you. We got some mementos as well. Let's start with Mr. Jamwal. Here you are, sir. Thank you so much for being the moderator here. Danda first. Thank you. Madhu, it was fantastic. You brought in a very different perspective to all these angel investing conversations. Thank you so much. Oh, we have Munish first. Great to see you, sir. Here you go. Thanks for a good conversation. Thanks. Thank you, Rahul. Good insights. Here you are. Thank you so much. Thank you, sir. Thank you so much. Thanks. We'll catch up soon. Yeah.